Move on to a crash course in how the macroeconomy can affect crypto prices. The macroeconomy, which is really interest rates, central bank policy, all of that over the short term can manipulate asset prices. So central banks control money, the fiat currencies that we use to trade. And they control the interest rates on the debt that we take out, and they control the supply of currency that we use. And they do that to try and push and pull us into this kind of smooth and predictable way of moving in the economy. So every central bank tries to grow its economy a certain amount. And of course, economic growth is not the same around the world. Some countries have a young population that are growing and producing more value. Other countries have an elderly population or an older population that are just past their best years and are not producing as much as they did before. In any case, central banks know that they can't control that. You can't control demographics. But what you can try and do is slow the pace around and not make it, too crazy, because financial markets don't like to be upset. If they know where the destination is, they're fine with that. And if they get there slowly, then they can plan for it. But if things are unpredictable, markets are mayhem. And so central banks really just try to slow the pace or the extent of any, financial moves that may rock the pricing mechanisms that we use to trade. And so what this has come into in modern finance is really this cycle of macroeconomics. And so everything is tied into one, of course, because everything that happens in the world influences the price of the assets that we trade. But the main cycles that we can look at really that influence what the price of Bitcoin is on a given day, or what interest rates are. The cycles that influence that are the business cycle. So that is, the business cycle has periods of expansion where businesses are taking on more debt or, raising more cash and selling equity to expand, bring on employees, which reduces unemployment. A lot of employment in the economy means people are earning money, and so the economy can grow. And of course, the other side of that is the times when that business cycle kind of deflates a little bit. Maybe businesses are making people unemployed. That leads people to save a little bit more and pull back, and so you get kind of a dip within the economy. So the business cycle for businesses, are they hiring or are they firing? Are they growing? Are they kind of paring back, right? So that's a business cycle that will, of course, affect the price of assets, Bitcoin, housing, everything else. There is also a debt and refinancing cycle because most businesses use debt to fund growth. Governments use debt to fund growth. And there is around a 3 to 5 year financing cycle. So the average maturity of debt is around 3 to 5 years. And so every 3 to 5 years, what do? Do you pay off the debt? Do you refinance the debt and, try and get more growth? Right, so that is going to influence things, right? The demand and supply for debt. That is a market within itself, and the interest rate that is charged on that debt is going to massively affect the economy and therefore prices of everything we trade. There is also an election cycle, right, because most governments are going to try to get elected. And how do you get elected? People have got to feel good about their situation, which means their assets are going up in value, they have employment opportunities. And so you're going to try and put political pressure on the central bank to try and raise or lower interest rates for your political gain. It's definitely an influence on things. And then, amongst all of this, we have the Bitcoin cycle, which is the cycle Bitcoin has every 4 years to halve the amount of new Bitcoin coming into the supply. We know that Bitcoin has this inflation schedule like this, where it eventually top out. We're somewhere here right now. Every block of Bitcoin that is produced, you get new Bitcoin that is made and paid out to miners as an incentive to carry out transactions. Every 4 years, the amount of new Bitcoin given to them is cut in half, and therefore the supply changes. So you have the Bitcoin cycle as well. That happens every 4 years. This happens every 4 years. This happens every 4 years. This just happens to coincide with debt, and elections happens to be around 4 or 5 years. These are short-term cycles. So that is very different to secular trends. So we're going to look at this on charts right now for crypto assets, because secular trends are entirely different to cyclical patterns within prices. Election cycles, debt refinancing cycles, the central bank lowering or raising interest rates on the debt that we pay changes prices within the economy. These happen in cycles like this. However, what central banks cannot influence and governments cannot influence, really, long-term, are these long-term secular trends. What is a secular trend? Technology is a secular trend. Computing is a secular trend. Internet adoption is a secular trend. Bitcoin and crypto adoption is a secular trend. AI, technology again, is a secular trend. Right, so what we can say is prices move in cycles based on what central banks and the business cycle are doing. But over the longer term, secular trends will get moved by this, but eventually just go in the direction that they are destined to go in, which is growing. So you have something, an invention of something that starts small, solar panels, self-driving cars, AI, the internet, and eventually that thing is just desirable by enough people that the thing just grows over time. But it doesn't grow in a straight line, of course. It has cycles along with adoption. If there is a recession, that means people are doing less stuff and they're demanding less stuff, and so the price goes down. But when there is another expansion in the economy, then that will go up. The long-term secular trend, though, is what investors look at. So if you have a time horizon of 5, 10, 15 years, which most people investing for their retirement or anything will have, then what they're really looking at is secular trends. You don't want to be trading cycles over and over again and trying to buy, sell. You're just looking at what things are growing in a secular trend over time. And I'll be buying here and buying here, but that doesn't matter because over time, the trend is up. So that's what we want to look at. There's a big difference between cycles and secular trends. Secular trends can happen to the upside. They can also happen to the downside. So you can get cycles within things that are actually getting worse or less desirable over time, or just becoming less valuable. So we can obviously get caught out on both of these. For example, we can get caught out in secular trends to the upside by buying here. The price falls down, we get upset, we sell here, and we've just traded the cycle the wrong way round, and we aren't aware that what we're doing is actually in a secular trend to the upside. So if we just kept it and dollar cost averaged, we would get higher at some point in the future, right? Secular trends happen to the downside as well, in that you can maybe get into something here, it looks great and you think you've made money, but then the next trend down is lower, right? You can see this trend. So secular trends and price cycles happen, and that's very important to be aware of. But what's way more important is the secular trend of that thing. Because if you're confident in the secular trend, you can invest in it. You can't invest in cycles. This is an example of a secular trend. This is the purchasing power of the dollar. Now, this is an example. Most other fiat currencies look exactly like this as well. Whereas the purchasing power over time, in relation to a bunch of desirable assets, has just gone down. This means that if you held dollars in 1971, they're worth around 20% of what they were then. So if you hold the same dollar, you can only buy 20% of the things that you could buy in the 1970s. There is a reduction in the purchasing power of the dollar. That just happens to coincide with the circulation of the dollar, which has risen. So as more dollars have been printed by the central bank, or the government by issuing debt. So it's putting fresh new dollars into circulation. That has been printed at a faster rate than humans have printed resources through their efforts and their value and their labour, or the fruits of those labours like goods and services. More dollars are being printed over time and put into circulation than value has been created. This creates a debasement of the purchasing power of those dollars in relation to the goods and services produced. So there's more circulation. That's a secular trend, because we're looking over the long term. A secular trend of more currency in circulation and less purchasing power. There are cycles within this, but the secular trend is very clear. All investors know when they start investing, when they realise this, is I need to get out of that fiat currency if I have savings that I want to protect from this currency debasement over the long term. It's not about making money in the markets, it's not about trading, it's about knowing the secular trend is that fiat currency has been losing its value, and so we need to escape that and put our value in things that do not debase at the speed and rate of this. This is a secular trend of the purchasing power of fiat currency going down in relation to desirable assets. This is another secular trend, which is the Federal Reserve in America and the size of their balance sheet. We're not going to get into how this works. We can just look at the secular trend in that it seems like the Federal Reserve, their balance sheet is getting larger over time. How does the Federal Reserve buy these assets? It prints money to buy them. So the secular trend is that the central bank is printing money, increasing the supply of money to buy stuff. What that does is debase the purchasing power of everyone else's money because there's more currency in circulation over time. They are buying assets, printing money to do so. This is a secular trend with cycles in between. This is also a secular trend. You can very clearly see that there are cycles here, but since the 1950s, with cycles in between, this is a secular trend to the upside. This would have been a great investment. If we started down here, we've made tons of money. Unfortunately, what this is inflation. This is the price of desirable things in the economy over time. The price of desirable assets and things that we need to buy to stay alive, like food and shelter, are going up exponentially. This is not good for us because the things that we want to stay alive are becoming more and more expensive. Now, this alone doesn't matter too much because as long as your wages are going up at the same rate, then things aren't getting more expensive for you. So you have to look at your wages and how they're increasing in relation to the inflation of goods and services. And of course, wages may go up. Overall, they may not go up, and so inflation actually makes you poorer. But what we can, get from this is that the price of stuff that we want never goes down, ever. When it goes down, what happens is that the central banks step in and force the price of everything up again. It never goes down, it just goes up at a slower or faster rate. So these things are linked, right? You can see that the purchasing power of money goes down over time as the currency in circulation increases. That is also tied to the central bank, which prints money to buy assets for itself to try and control things in the economy. And inflation goes up seemingly in line with the fact that we have so much money creation for some reason that is pushing prices up. So these are secular trends that investors inherently know. My dollars or fiat currency buys less stuff over time. I don't like that. So I need to sell that for assets that go up at the same rate as the other things that are going up that I want to buy. And in 20 years when I retire, I will have saved the purchasing power of my money in those assets. So those are secular trends, but we can also look at cycles as well within parts of the economy. So this is from GMI here. We have inflation, which, as you can see, moves in cycles up and below around about 2%. Central banks around the world, most of them have a target of 2% inflation. Don't ask me why they have that. Nobody knows the reason. They just picked 2% as some number that if it happens at 2% a year, no one will really notice that the things they're buying are going up in value. And so what they try to do with their central bank policy is to keep this inflation rate around about 2%. What is the inflation rate? CPI, which is the Consumer Price Index. It's an index of the things that consumers can buy in the economy: meat, vegetables, Netflix subscriptions, everything like that. Now, CPI is just one metric of inflation, and really, they change it all the time. So CPI can be changed by the indexer, the government basically. They can take one thing out and put another thing in. And so CPI doesn't really mean much, especially if you change it over time. Also, when you're looking at consumer price inflation, a lot of things that we buy over time actually get cheaper because of technology. We produce more of them, we have economies of scale, or we digitize them to make them cheaper. In any case, that CPI is still going up. And is it the things that are getting more expensive, or is there just simply more currency chasing the same amount of stuff, hence pushing the price up? In any case, inflation moves in these cycles. So sometimes it goes above 2%, sometimes it goes below, like this, right? But we know that even though these cycles are taking place, and they will be changing the price of assets and the supply and demand and everything like that, we know that the actual secular trend is just positive. All of this mostly is positive in terms of there is more inflation, right, in CPI. So CPI moves in cycles, and inflation will inhibit a response from the central bank. If inflation gets too high, central banks will try and reduce activity within the economy, maybe an economic slowdown. If inflation gets too low, they'll try and stimulate the economy by lowering interest rates to get it around this 2%. That's what central banks want to do. That's their official remit, is to keep inflation around 2% by stimulating the economy or drawing it back. You can see here that this is the official interest rate for US Treasuries, which are the benchmark for what debt trades at. So you have US Treasuries, which will trade at a certain percentage, let's say 3%. Everything else is priced off that. If you're a company, you're a lot more risky than the American government, and so maybe you have to pay 10%, which would be, this plus 7, and that would make 10% as your spread as a company. So all interest rates are really set off of this. Now, what we can see here is cycles within a secular trend. You can see the cycles here, they move. These are the cycles, but the secular trend is that interest rates have been coming down over time. So things move in cycles, but we can't get caught out by those because we need to look at the longer term secular trends. But we can also maybe take advantage of those shorter term cycles as well if we're confident in the secular trend of something, right? If trends are topping out and you know that there's a secular trend to the downside, maybe you can trade to actually make some profits around these changes in the cyclical patterns alongside the secular trend that you think that's happening. This is global liquidity. This is a measure of how much money is flowing around central bank systems, because they try to manipulate prices and economic activity by sloshing around money. They pour it in, they take it out. They want everything to be moving at 2%. We can see that this is cyclical as well. So you get drawdowns and, you get points where liquidity is higher. This seems to move in cycles. So liquidity moves in cycles, which is an attempt from central banks to manipulate prices in cycles. However, cyclical trends rely on fundamentals like demographics, How many people are being born? How much value is being created? Is something in demand and going to be in demand over a 20-year period more and more and more? We know the difference. So, what do we want to do? We want to watch out for cyclical trends to invest in, right? Because we've got this money that we're earning and we need to save some of it. That's why you're here, right? You're looking to invest or trade crypto, and you're looking to save, purchasing power of your money over time. You're looking to make dollar price gains or fiat currency price gains in assets that go up over time. So we know, what we need to know is something in a secular trend? And if it is, how can we take advantage of price cycles to get the absolute best prices, right? Investors, if you've got a 20-year time horizon, you just want to invest in secular trends. Invest for a long time, wait an even longer time. The trend will have carried the price and the value up. So what you can see here is this is the Bitcoin price, and we can very clearly see that it is, one, really volatile, but it also has traded in a couple of different cycles. So you can see an expansion cycle here, you can see a destruction cycle, you can see an expansion cycle, destruction, it looks like we're going in expansion. So it seems like the price moves alongside cycles within the macroeconomy, like this, right? So what we have here is liquidity moving up and down, and Bitcoin moving up and down. So what we're going to do is press indicators. Like I said, TradingView that I'm using now is completely free. Definitely recommend an account. They'll be linked below in the description. You just need an email address, sign up, and you can use this. We're going to look at global net liquidity, which is a measure of the liquidity from central banks. So are they pouring money in to stimulate, or are they taking money out to try and, calm down growth? There is seemingly a correlation here. We have an expansion in monetary policy, we have an expansion in liquidity. That just happens to coincide with Bitcoin going up in price. As money is drawn out, you can see that just so happens to coincide with the Bitcoin bear market and the price going down. We have another massive expansion in liquidity here. That just happens to coincide with a big price expansion in liquidity in Bitcoin. We have liquidity coming down here, and we can see the Bitcoin price going into a bear market where the price goes down. These things have a very high correlation. So what we can understand from this is that it seems like the amount of money in circulation from central banks affects asset prices in cycles. When there is an expansion of liquidity in central banks, what they're doing is increasing the supply of money. And conversely, things that have a fixed supply, or a supply that can't change as quick as that, have to go up in value, right? So if you have the same amount of stuff, like Bitcoin or gold or a stock, and you have more dollars chasing that, then the price has to move, right? The price moves in cycles along with this. So this is very, very clear. So we can see that price moves along in cycles for BTC. So the other thing we can see is a secular trend. Now, this doesn't really seem like a secular trend. I mean, it kind of does a little bit, but you can't really see it. So what we're going to do is go down to the settings here, and rather than looking at the actual price, we're going to change the chart to a logarithmic chart. Now, what this does is it changes the price scale and compacts or compresses the price scale as the price of the asset moves up. And this creates a totally different type of chart that we can see. What we're doing here is looking at Bitcoin since inception and its price. And it's very, very clear that we can see a secular trend. If you want to know exactly how to use TradingView, by the way, I have a completely separate tutorial video. It goes through absolutely everything, using the charts, using the drawing tools. So I'll leave that link below. But what we can see very clearly now is that we have a secular trend in the price of Bitcoin. Now, Bitcoin is a monetary network, and so more people are adopting it over time. We'll look at that data. But even though the price is moving in cycles, which we can very clearly see, expansion, contraction, You can see all of that happening. What we can tell, that was drawn quite badly, but what you can tell with these cycles is there is a secular growth in the price of this asset over time. Secular growth with cycles in between of boom and bust. But the trend for 15 years is that within these cycles, Bitcoin adoption is growing and therefore price. Let's have a look at another crypto asset just to see if we can get a trend here. So this is the price chart of Ethereum. We can see some cycles here, right? So boom and bust for sure. If we put the logarithmic chart on, we can see that again. So it tends to give us another secular trend, right? So we can draw that on the chart from here and upwards. We see again that there is a secular trend that seems to be growing the price of this asset. So cycles of boom and bust, but very clearly a trend to the upside. So in each bust, the price is higher. In each boom, the price is higher. What's happening here? You have an asset that starts at zero or close to zero, and you have adoption, a secular trend in adoption over time. More people are using this thing. It goes from tiny to small medium to medium to medium large to large. At some point, the pace of growth will slow down. And that's fine, that happens to every asset. But we can't get distracted by price cycles because what we're really investing in is the secular trend. We can, of course, take advantage of price cycles as well. As price cycles draw down, these are fantastic opportunities to invest in what we know is growing in a secular fashion to the upside. So we can buy every price and wait, or we can be a bit more tactical and try and buy more when prices draw down within the longer term secular trend. So let's recap how macro changes crypto prices. Now, that's a tiny amount of macro there. It's obviously a huge topic that could be a course in itself. But how macro relates to crypto. Short-term price cycles happen within longer-term trends. Traders try to time cycles. So you're looking to time this, right? Buy these lows, wait for a pump, sell here. That's more active, it's more risky, because we don't know where the prices are going. But investors just look at the trend and say, I'm going to invest for 10 years, then wait another 10 years for that growth to come. Cycles give all of us an opportunity to invest or buy at lower prices. Investors must be active buying assets when they are at the price cycle low. Otherwise, you're simply getting worse prices for the thing you want to buy. The whole idea here is to buy the most stuff at the cheapest price. You can do that by being extremely early and taking way more risk that the thing you're buying simply is a bad idea. Or you can wait till something is bigger, but you have to invest when prices are relatively lower than the expansion cycles. Otherwise, you're just simply paying more for the same thing. So we can use macro cycles to our advantage to know that we have assets that have secular growth, and during these price cycles, we don't get scared, we don't get taken out of what we're doing. We invest at those lows. They're going to give us the best returns. Understand that cycles draw prices down, especially in crypto. This is a new asset class. It's volatile, it's young, it's not valued highly, and so it's going to be very, very volatile to the upside and to the downside. So we need to make sure that we're active when the downside price cycle hits and investing in things that actually have long-term growth. The best time to invest is at the low of a price cycle. Invest in secular bull assets during cyclical bear markets. That doesn't mean that everything we buy that draws down is going to recover. That's also the risk with investing, is that many of these things will have one cycle go down and then keep going down. That's obviously the risk. But we know that the things that do grow over time give us plenty of opportunity to make money because we're still early on in crypto. Let's move on to Bitcoin, why it spawned the crypto industry, what exactly it does, and why more people are coming to the network over time. Very clear to see that Bitcoin over time is growing. It has price cycles, but the secular trend is to the upside. Why is this? Bitcoin is often called money, or the strongest form of money, right? Hard money. And the reason is because it has a cap in the supply. So it's an asset that runs on a decentralized network. So you can essentially own this asset. No one else can fiddle with the asset. They can't change it in any way. It's 21 million coins and that's it. It's non-government money. It's an asset that you can hold digitally. So it has some desirable properties, right? It must have, because a lot of people are coming into this. People say that Bitcoin is money, but is it actually money? Money itself isn't actually real. Money doesn't exist. There is no such thing as money. There are assets and liabilities. Each one of us has a balance sheet. We have this individually as people. So we either own assets or we have liabilities that we have to pay for. Companies have assets and liabilities, and countries and governments have assets and liabilities. Many central banks around the world own gold. Many of them have huge liabilities to pay out in social security and other things. Money itself doesn't exist. Cash, fiat currency, that's not money. That is just a way that we account for the balance of trade between people, where they're buying or selling assets and paying out their liabilities. The way that we do that is simply by having a unit of account that we all agree on in some way, right? So I've got $1, you've got £10. That's just a number, completely irrelevant number that doesn't mean anything apart from the system by which we exchange these for goods and services, and we accept that that number that you're saying, which is 10, is enough of a number to pay for the thing that I'm selling you. So it can be a physical sheet, it can be a number on your phone when you're just paying for something. So money itself doesn't exist. There is only a balance of trade between individuals, and the way that we carry out that trade is through exchanging numbers. We used to exchange physical goods like cows and chickens. That wasn't a good way to do things. Then we eventually came to shells and salt and everything else. Then we eventually came to, let's just exchange numbers and use a sheet of paper to do that. Then we realized we can just send it on our phone, so we send a number on a phone. But all of that eventually became centralized, right? So you needed banks and needed governments to make sure that people weren't, taking things into their hands and scamming everyone else. Bitcoin. We use currency as a number, a made-up number to account for the balance of trade during financial transactions. Fiat currency is unreliable because there is a long history of governments printing more of it. We've just seen that, the purchasing power of dollars going down over time. The reason governments print money is to pay for national security, military, health, education, and they can print and print and print because they're the only ones that own the money printer. We're not allowed to own our own money printers. That's illegal, and we'll go to jail. Only the government is allowed this monopoly on money. Therefore, they can print as much as they want, unless we get tired and throw them out of power, right? The problem is it distorts the way we account for value within the economy when you are printing money and pushing it out into the economy. People who earn value need to save their output in an asset because the currency is unreliable. Every currency ever invented, every fiat currency has been debased by the people in charge of it. Because they don't want to lose power, they print to take power from other people through their military, or they bribe voters by printing money and giving them free healthcare and free education in order for their votes to stay in power. But what that does is debase the purchasing power of everyone else's currency. Therefore, we all know that if we want to save the value of our value over time, the things that we've outputted into the economy and received income for, We need to take it out of that currency, which is being controlled by someone else who we don't trust, and we need to put it into assets. Stocks, stock indexes, gold, housing, anything else. Art, diamonds, right? Because we know that they control the money and they fiddle with the supply. Assets are priced based on supply and demand and desirability of them. Bitcoin doesn't do anything other than give us a promise that it will always be there and it will only be 21 million coins. And if we compare that to the fiat currency, there may be some desirable properties of this type of asset. Maybe Bitcoin and maybe other networks can do this as well if they're sufficiently decentralized and they won't be fiddled with. So what is money? It's a medium of exchange. That is something that we can exchange to account for the balance of trade between you and me. I earn money, I go to your shop, you sell me a coffee, you tell me it's 3, I give you 3. Right? Doesn't matter what we call it, dollars or pounds, doesn't matter. It's something that we all say, this is 3 of that, I agree. Right? It's a unit of account, right? So we have to account for the balance of trade, and it's a store of value. Well, fiat currency isn't a store of value. We've definitely seen that. And so that's why we use all of these other types of money. For example, housing or gold or commodities, right? So what is money? Well, money can be pretty much anything. It's something that we associate with value that we can exchange freely for the balance of trade of goods and services. Ultimately, what money is a database. It is a way to put inputs in and create outputs, right? It's a unit of account. It has to be stored somewhere. So fiat currency does this by having a central bank and then consumer banks who keep a value of the balance of trade of all these numbers flowing around. And that is their database. A central bank is a centralized database controlled by the government. And they can print the money, they can control it, they can stop you having access to that database, right? That's not great. What is cash? Cash is also a database, but it's different than the central banks because it's physical. So as long as someone else accepts that cash from you, that is also a balance of trade transaction, and it has numbers on. So that's the way we account for that. The way that fiat currency's database is controlled is through military operations and power, right? What you're saying is no one else is allowed to control this database, and if you do, we'll put you in jail. You can't have your own money printer. Also, if someone else tries to take our database from us, we'll use our power. Centralized databases that are controlled through power and physical force. Bitcoin, it is a database that is decentralized around the world. No single party has ownership of it. No single party can control it. It is a decentralized database that no one can have specific control of. And so we use the proof of work network in Bitcoin with energy. People that want to earn Bitcoin by mining this network need to have energy. There is a cost associated with having this network, and there is a cost associated with trying to destroy the network. If you want to destroy the network, you can't just use force. You have to get energy. You have to get 51% of the network to control it. That's almost impossible because of how decentralized it is, right? Anyone can mine the network, decentralizes power over time. Is it absolutely perfect? It's certainly the most perfect thing that we've discovered so far, and it's certainly more perfect than centralized databases controlled through force. So Bitcoin is very simply a cloud database. That's all it is. It's a database that we can use to transact in Bitcoin. It's fixed in supply, it's decentralized, it's not controlled, and therefore it might have some desirable qualities if you're looking to preserve the purchasing power of your value over time. like I said, there is no such thing as money. There are assets and liabilities, and there is the balance of trade. What we use for that balance of trade really has changed throughout time. Salt, clamshells, right, coins, and some people are using BTC. There is no centralized issuer. It is fixed in supply. It is self-custodial if you want it to be. You can have, it's a bearer instrument. You can have ownership of it, actual ownership, right? It's not in a bank. It's not controlled by a centralized party. Bitcoin is absolutely impossible to replicate as a thing. It just is the invention. You cannot create a new Bitcoin. No one would want it. Bitcoin is the culmination of the consensus of the people that use it, that this is the best thing for them. It's pure capitalism.